Most people don't remember the first time they felt investing was confusing. They just remember the feeling that it wasn't built for them. You did what you were told, you saved what you could. You put money into a fund and trusted that time would do the rest. But every time markets moved fast, you were always late. You reacted after the day was already over. You never quite knew what price you were getting or why. Investing didn't feel risky because markets were volatile. It felt risky because the system was opaque. For decades, the default way to invest was through mutual funds. They promised diversification, professional management, and long-term growth. And on the surface, that sounded reasonable. But underneath, the structure worked very differently than most people realized. You couldn't buy or sell when markets were moving. Everything happened at one price, calculated after the market closed. No matter what happened during the day, you waited, and hoped tomorrow would be kind. Fees were quietly deducted year after year. Small percentages that didn't feel dangerous until time magnified them. You paid to enter, you paid to stay, and you paid again when you left. What you actually owned was hard to see. Holdings were disclosed infrequently. Transparency arrived late, if at all. You trusted the system not because you understood it, but because there was no alternative. And over time, a quiet frustration grew. Markets were becoming faster, more connected, more digital. But investing still felt stuck in another era. By the year 1980, the problem was no longer subtle. It was structural. The question wasn't how to beat the market. The question was why access to the market felt so inefficient in the first place. What if a fund didn't move at the pace of paperwork? What if it moved at the pace of the market itself? What if you could see the price change in real time? What if you could buy or sell when information mattered, not hours later? The idea was simple. The execution was not. In the early year 1990, a new structure quietly emerged. Not as a marketing innovation, but as a mechanical one. In the year 1993, a fund launched that tracked the S&P 500. But unlike anything before it, it traded like a stock. One ticker, one price, updated throughout the trading day. This wasn't just convenience. It was a fundamental shift in how investing worked. Behind the scenes, a new process made it possible. Instead of constantly moving cash in and out, large institutions exchanged baskets of stocks for fund shares and back again. This in-kind process kept prices aligned with the market. It reduced forced selling. It limited unnecessary taxes. Most investors never saw this machinery, and they didn't need to. All they experienced was the result. A fund that told you its price immediately. A portfolio you could see clearly year. Costs that no longer silently compounded against you. The system stopped guessing your intent. It responded instantly. Authorized participants handled the complexity quietly in the background. Arbitrage kept prices honest without manual intervention. Efficiency wasn't a promise anymore. It was built into the structure. For the first time, investing felt less like a negotiation with the system and more like direct access to the market. Once that structure proved it could work, expansion was inevitable. New ETFs followed. Broad markets, specific sectors, international exposure. Each one offered a precise slice of the global economy. Each one using the same transparent, efficient foundation. By the early year 2000, ETFs were no longer an experiment. They were becoming infrastructure. Trading desks adapted, institutions adapted, and gradually, individual investors did too. Investing stopped being something you handed over blindly. It became something you could monitor, understand, and respond to. You could see what you owned. You could see how it moved. And you could decide on your terms. ETFs didn't remove risk from investing. They removed unnecessary friction. They didn't promise higher returns. They promised a fairer system. A system where time worked for you, not against you. Where transparency replaced trust by default, and where access was no longer reserved for institutions. ETFs weren't invented to make investing exciting. They were invented to make it make sense. And in doing so, they quietly changed how the world invests.